Welcome back to tutorial information again. Kindly subscribe to the channel and don't forget to click on the phone bell so that you can be notified whenever I drop a new video. Alright, so today we're going to look at the final part of borrowing cost according to IAS 23. So in the previous video, we were able to calculate the capitalize the loan or the borrowing cost. And also, we're able to express the borrowing cost. Now, one thing that you need to understand is that this loan that we have here, 30 and 40 million, they are the loan borrowed to finance that asset or finance the project. Okay, so it is mandated that we have to pay back this loan. Okay, and the value of the asset is this 70 million naira. Okay, and when we computed the interest or the borrowing cost of the loan, we were given that our loan is 7 million naira. Okay, and also we're able to capitalize 836,333 naira, and also we have the interest expense as 1,863,767. Okay, so right now we're going to quickly just look at applying the double entry principle to be able to prepare our income statement and also prepare our balance sheet. Okay, so we know that according to the double entry principle in preparing income statement. So I'm just going to quickly draw that below here. So if you have not watched the previous video, I'll attach the link to this video, and also kindly watch the video, okay, the previous part of the video. So right now we have income, the income statement, okay. So then we have the income statement. Okay, so let me just quickly write that way. The income statement, the income statement, okay. Income statement, okay. So we know that we have was gross profit. The gross profit brought down, okay. The gross profit brought down. Let's have the naira sign there. Naira sign. Okay. So we have the gross profit brought down. This is the format. So the gross profit brought down. So the gross profit brought down, we're not giving any information in regards to that. So we're not giving any information in regards to that. Let's put the dash here, okay. And we used to have less expenses in the income statement, okay. Now the interest expense, okay. The interest expense will now come down to the income statement, which is interest. So interest So the interest expense, this is the interest level expense, is 1,863,667. Okay, 667. So, and this is the only information that we have, okay, in that question that will go into the income statement. So when we take out the incomes, the gross profit brought down from expense, okay, we're going to have 1,863,000 863,000 863,000 3,000 667 667 7. Okay. So we're going to less this. Less. We're going to less. At the end of the day, to become what? To become a net loss. Okay. A net loss. 1,863,667. So recognize it as what? As a net loss. Net loss. Net loss. So now, to prepare the balance sheet or the statement of financial position, balance sheet, or let's say call it the statement of financial position. Now, the statement of financial position of financial position. Okay, position. Okay. Now, we have the assets from the question. We are given a loan of 70 million naira. Okay, this is a non-current asset to finance the building. Non-current asset. Okay, non-current assets. Okay, so we're going to apply knowledge in double entry. Suppose this. Okay, so we have the building. The value of the building. That is the initial cost borrowed. Okay, initial cost borrowed. Okay, that is 70 million. 70 million, and then we have the capitalized borrowing cost. Okay, the capitalized borrowing cost of 836,000. 333. Okay, this is in millions. Okay, this is in millions. Okay, right, this is in millions. You can write a millions in full. So then, we have 70 million 836,000 Okay. So now, do we have any current assets? Current assets. No, we don't have current assets here. So the total assets is 70 million 836,000 Okay, so let us go to the liabilities now. So liabilities. Okay, liabilities. We have for liabilities we have so for liabilities we have current liabilities. Current liabilities. Okay, so current liabilities, we have the interest on loan of 2,700,000. Okay, so we also have non-current liabilities. Non-current liabilities. Okay. So non-current liabilities, we have bank loan. So let's take the bank loan again in the question. So let's check the bank loan that we have. Let's check the bank loan. So the bank loan is 30 million naira and the debenture is 40 million naira. So 30 million and 40 million naira. Okay, bank loan. That is 30 million. 30 million. Then debenture 40 million. Oh, debenture, okay, 40 million. 40 million. So we have a total of 70 million. 70 million. Okay. So we have finance by. So we're not giving any information on capital. We don't have any information on capital. We have net loss. The net loss is 1,863. 1,863,667. So let's add up and take away the net loss, okay? So we have 72,700,000 minus 1,863,000, okay? So let's take that out using our calculator. So we have 72,700,000 minus 1,863,667. So we have 70,836. 70,836. So we have 70,836,333. So we have 70,836,333, okay? 836,333. So you can see that so this shows that the liability and capital side balance, okay, with the asset side, as you can see here, okay, you can see here. So the two sides are balanced. We have 70,836,333, which is the same with what we have here, okay. So 70,836,333 and 70,836,333. So this is just the way by which you can, post the transactions that we have in the borrowing cost, okay, based on the loans that were borrowed to finance the project in the question that we have. And this is in relation to the information that we have in that question. Any information that we have there is what we're going to use, okay? So with our knowledge of the entry principle, this will guide us on how we're going to prepare this transaction. I hope this is well understood, and thank you so much for your interest and for listening and for watching this video. I really appreciate it. See you in the next video. Thank you.